Hello, everyone, and welcome to the fourth episode of Hashing for the Holidays. Today, we're going to cover financing for miners, treasury management, all things related to funding. So for this conversation, I have a few friends to talk about their experience with mining. So gentlemen, let's give a brief overview and introduction. Chris, let's start with you.
Sure. Thank you for inviting me, Amanda. I feel like the most lightweight person here, considering the topic. I'm a researcher on this topic, much more so than an actual hands dirty type of involvement like some of these other guests. But what I have done is researched the space for quite a long time, since before it was cool, and I've had the privilege and opportunity to track the developments in the space quite early, starting already in 2017, trying to do some more comprehensive work on the space. So hopefully I can add some perspective from that angle.
The OG, we need one in every episode, Chris. So
sure.
There we go. Ryan, do you want to go next?
Yeah, sure. Also, thank you for the invite. So I'm VP of product at Galaxy. I've been at Galaxy for about 5 or 6 months now. What that means is I touch a little bit of everything we do on the mining side of things in Galaxy. So both on the prop mining side, so self-mining, where Galaxy sort of has direct exposure in mining economics, as well as our miner finance side, which we'll probably talk a little bit more about today. And prior to that, I was at Fidelity. I was director of Bitcoin mining there, and more or less spent 3 or 4 years on Bitcoin-related topics at Fidelity before that role.
Very nice. Sounds like very familiar, Brian. I understand that background quite a bit. And last but not least, Zach.
Thanks, Amanda. So I'm the founder of a firm called Dalma Capital. We're headquartered in Dubai, so you can see it's a little bit darker here where I am than everyone else. We have over $1 billion of assets under management and under advisory as well. We focus increasingly on the crypto industry and being an investment banker to the industry specific to miners. We're one of the only investment banks with international coverage of miners, meaning that we help miners inside North America access global pools of capital, and we help global miners access pools of capital across the world, including in America. So that's something that I'm super passionate about and really brought me into this conversation.
That's awesome. So Chris, I want to start out with you as our OG in mining. You were looking at things like hash rate distribution, right, a few years ago, like where is hash rate distributed around the world? How has your research into mining changed as the industry has changed quite a bit during this time frame? More information is obviously becoming available, right? Has that been easier or more difficult?
No, that would be the main thing. And I do realize now that I kind of forgot to say like where I work. And for those that don't know, I work at CoinShares. I'm the Bitcoin research lead there. I've led the research desk there for a number of years. I would say the biggest difference between researching this 4 years ago and researching it now is the amount of information that's available. When we first started out, we literally had nothing to go on. We had to start by trawling the internet and calling people and going on forums. Now you have relatively professional sources available to you. You have the great work that's been done over at Cambridge. You have distributions that are published by some of the pools directly. It's a lot easier, and a lot easier doesn't mean easy. We're actually about to publish a new paper, our first one in a while on this, where we focus a little bit more tightly on using this distribution data to calculate carbon emissions. And it's still not easy. Even with the new data that we have available, it still doesn't give us the level of overview that we want. Cambridge covers between like 32 and 37% total network. We think that we've been able to pinpoint around 31% of the network through publicly available information. So maybe together we have about 50% if there's some overlap. That's a lot more than we used to, but that's still not a lot. I mean, most of this industry is still relatively dark, and that makes it extremely challenging.
And, that kind of feeds into like Brian and Zach, your world, right? Like, how does the information that like sources like Chris creates, how does that feed into how you create products or, create research to explain what miners are doing?
Yeah, I mean, research from folks like Chris is definitely useful. I think the other thing as well is we've just seen more companies hit public markets. There's more public disclosures, which provides a lot of information for us to work with, and actually a lot more insight into how mining companies operate, right? It's very different from a world where most miners are private, and therefore a lot of the financial information and how other miners are operating is just much more opaque. I think the other thing as well is, especially from sort of a North American perspective, just the shift from hash rate from China specifically to North America, I think makes it a little bit easier for participants in North American markets to understand what's going on. I think flow of information is just more local, and it's a little bit easier to see what other miners are doing, I would say.
Yeah, it's certainly important to track data on where miners are, where their hash rate is. I mean, again, one thing that we're seeing in terms of hash rate distribution is similar to our one of the factors driving our thesis around financing the sector. We see the cost of capital coming down, and miners that have a more competitive cost of capital being able to outcompete others. The knock-on effect of that, though, is an increasing concentration of mining taking place on effectively on the NASDAQ. I don't know if I can share a slide, but I have a slide that shows the liquidity for publicly listed miners on the NASDAQ versus other exchanges, and it's just a very clear case that listing on the NASDAQ gives you the liquidity, it gives you the pricing, it gives you access to cheaper financing, which is a significant competitive edge. The concern that I have about that, though, is what it might mean for the network with more than with a significant portion of the network effectively coming under the SEC's jurisdiction in the not too distant future. So, I mean, this is just a brief slide showing the more liquidity for those on NASDAQ and NYSE, and how much less liquid you are going down the scale to other markets. So there's a clear move for miners to move towards the NASDAQ, which is probably going to mean, again, where the hash rate is globally physically happening versus where it's kind of legally exposed or regulated is going to become actually increasingly concentrated as a result of the financing environment.
Yeah, that's a fascinating topic, right? Of the rise of public miners, which has been a huge trend, I think, over the past year. And that usually is because of liquidity, right? Like everyone needs access to more capital because mining is super capital intensive. So let's talk about that for a minute. When we think about mining being capital intensive, there's this breakdown for miners between wanting, to have debt versus giving up equity. So do we think that, why do we think miners love to take on debt financing? Do we think at one point they're going to be leveraged too hard on the debt side that it will be difficult for them to access more funding on the other side?
I think briefly, if you are a miner, you're already quite bullish on Bitcoin, and taking out debt in an asset that you believe is going to depreciate against your income makes a lot of sense. Now that's probably their view, their financiers might not always agree with that, but I think that is probably at least a big, high level reason why that immediately strikes everyone as the more beneficial thing to do. You don't want to give away large parts of your future potentially deeply appreciating income if you can get away with effectively playing into the already ongoing speculative attack on the dollar. So why not?
Yeah, I would say also just, in advising miners, we look at a lot of miners that are making, EBITDA margins in the recent environment in excess of 70%. How much your equity valuation is really willing to price that in with the expectation of that declining in the future and then being kind of permanently on the capital stack versus the impact that you can have on your return on equity from taking debt, even if it's a high cost of debt. If you're looking at, again, even a 50% LTV, let alone guys that, we've helped miners get 80, 90% LTVs. At a 90% LTV, you're getting a, return on assets right now of 80% a year, 80 to 100% a year, depending on the price that you're paying for machines and your cost of electricity. If you get a 90% LTV, you're getting a return on equity of 1,000% less your cost of financing. Even if you're paying 20% for financing, it's 980% return on equity. That, for a shareholder is pretty tempting. Obviously, the current mining economics and recent mining economics have been very favorable, and whether they'll continue at these levels very long is something that we all wonder about. But I fully understand why miners are preferring debt to equity, and particularly again in the private equity markets, valuations, the valuation gap between private equity and public NASDAQ listed or NYSE listed equity is huge and is probably going to remain huge for some time.
Yeah, I think those are good points, and I think there's a lot to unpack here. I think first off, miners are definitely using both debt and equities effectively, and I think there's clearly a place for both, and it makes a lot of sense if we just think about this even first strategically, right? Where it helps you scale up a lot faster than simply reinvesting the revenue right into your business. And I think if we all agree that hash rate is going to go up and perhaps significantly over the next year or two, in terms of units of hash rate, you're getting a lot more Bitcoin perhaps today than you will ever in the future for the same amount of hash rate. So it makes sense to use both just as starters. I think the other thing too that I will say is, particularly for a lot of the points that Zach just mentioned, especially for a smaller miner, debt goes a lot further, where if you only have say 100 ASICs plugged in, getting diluted and giving up say 25% of your company isn't going to get you very far. And so using debt first to get to sort of this critical mass period where you then can take off through equity markets makes a lot of sense. I think the other thing that we're seeing too is just the use of Bitcoin-backed loans as well as financing against equipment and other types of infrastructure. And I think that's a really effective tool for miners to be using. It allows them to stay long Bitcoin and in some cases get cheaper access to capital than through other structures.
And we've seen, a lot of the public miners take the hold strategy, right? And use that Bitcoin as leverage to be able to get access to more capital, which is great because there are places now providing Bitcoin-backed loans in a way that help miners, right? So I think that Bitcoin-backed loans for miners is one of the best things that happen from a financing perspective, because it allows them to leverage the assets that they have and also then get access to more fiat. Let's talk a little bit about loans for miners. So obviously, there's a lot of companies that have come out over the past year or two that are funding miners from an asset-backed financing perspective through basically machines. And obviously, Brian, Galaxy being one of them. Why do we think that some of the financing arms are only financing miners as machines and not, the infrastructure facilities behind it?
I mean, I can start very quickly. I think a lot of people think mining is easier. You just buy some machines and plug it in. But if we think about financing a really vertically integrated structure, there's energy assets, there's data center assets, there's mining equipment assets, and having the expertise to sort of model that out and make sure that you're managing risk appropriately across all of those different assets takes a lot of different backgrounds and a lot of expertise there. And so I think focusing on maybe a narrower portion of that, so let's say the actual equipment that's hashing, takes maybe a little bit of a narrower range of expertise where, we can model mining economics. We understand sort of what the collateral is there, understand what the margins are, and maybe feel a little bit safer doing just that. That being said, I think, underwriting sort of other types of assets is probably something that's more familiar from traditional financial institutions. And so I definitely would expect, more players to come into the space and probably actually see that becoming more common over the next couple of years.
Yeah, and I would agree with what you're saying, and certainly see the role of financing infrastructure coming more from traditional financial players. Again, a lot of the debt financing that we're seeing in the industry is coming from firms that are more crypto native and have that expertise, but that also actually have a very high cost of capital themselves, and therefore, when looking at providing financing, need to finance the part of the business that has also the highest return on capital. The return on capital, return on assets of the infrastructure, doesn't have nearly the margin of machines. These are also typically, again, from what we see, the tenor on those that are crypto native or crypto familiar in their financing. The mining industry, they want their capital returned to them in a pretty short-term period. Longer tenor financing really needs to come from private debt funds, and we are seeing an uptake of those coming into the sector. Again, they also have better comfort around that collateral that they're financing it against. They understand, transformers, and that people are going to need transformers no matter what happens to Bitcoin, and that these are assets that have a lifespan of 40 to 70 years. But I think, again, traditional finance and traditional financial firms that can provide longer tenor financing, have a lower cost of capital that's somewhere in the single digits, is really where we need to see financing of infrastructure coming into place. And that's part of the work that I think that the industry needs to do is get traditional financial institutions and players, even the alternative types that we're seeing that are more likely to be interested and comfortable in the space to really get that additional comfort that these are businesses that they want to support.
Mm-hmm. Chris, anything you want to add there on asset-backed financing versus infrastructure?
I think there's probably a bit of necessity for some Lindy effect to happen here. The space just needs to grow a little older and show some longevity. This conversation would be ridiculous 4 years ago. 4 years in, the amount of distance that we've traveled and the size and the competence of the players that are now, starting to sniff around for opportunities is incredibly different. I think time is like a huge component here. This needs to be shown to be a stable industry that isn't going to just disappear overnight. We need to get away from this sense that Bitcoin's just going to implode one day and that the mining network's going to blow up or whatever. So the longer we can go, I think the more people will be interested. There's money to be made here. So
that goes back to why some of the research that you do, I think, is really important in some of these conversations, right? So we have to explain things like, here's mining economics, and then this is like hash rate growth, and you have to know or have an idea of what you think Bitcoin price is going to be modeled out at, right? And all of those things never track with what your model actually says, right? So coming from traditional finance, it feels like it's a really huge barrier to entry. So we all know on this call that hash rate is going to continue to grow. All of us are tracking the public mining company announcements. We know that the hash rate is just going up, right? What do we think will happen when margins start to compress for miners? Will we see some of the entrants, the traditional finance entrants, people that are starting to look into it now, withdraw because they're like, oh, things are changing, hash rate is growing? How do we think that dynamic is going to play out over the next year?
I feel like it's going to depend on the severity of the change. Say that we get another really hardcore or like drawdown in price that's protracted to the point where, difficulty outgrows the price again. If that happens, I think a lot of people are going to get a really hard introduction to how mining economics can work. That's not how they've worked now for years. It's been gold rush for, since 2018 or 2019 almost. Well, parts of 2019, 2020. But that's not how it always is. This could be very harsh, and I hope everyone's ready for that. That's kind of partly of what our job is, I suppose, is to educate people not only on how it works, but also the history of how it has worked and what that could have as a consequence for these investments.
Something I'm equally worried about, or maybe even more worried about, is the effect. A lot of miners, including those that are public, have made promises to the market that are being priced in and that may be challenging to deliver, if I'm putting it politely. And then their suppliers have been making promises that they may struggle to deliver. What I'm concerned about is those that have overpromised and that will inevitably, face some kind of correction, may cast a cloud on those that have been more conservative and made more reliable projections, or are using more reliable suppliers that will actually be able to deliver to those outcomes. So I think that's something to be mindful of. Going back to the previous point that you made, Amanda, though, the importance of research is critical. I mean, we can see the effect that increasing sell side coverage of miners and mining stocks is having. We really need to see some tier one sell side coverage of public miners from the tier one investment banks. And the reality is that the tier one investment banks only cover deals that they're doing. So that's been incredible work done by some of the big public miners in really evangelizing the sell side research, so that the market knows better how to price miners and how to distinguish between those that that have better value than others. So that's something that is absolutely crucial for the entire industry, and it will flow down to the cost of finance for the industry as it becomes better understood.
Yeah, I think
this is something. No, go ahead.
Well, yeah. So I was just going to add, and this was all Chris, a point that you made, Chris, is that it does depend sort of, what happens with the relationship between Bitcoin price and hash rate, because I think fortunately we are still in a good position right now where, hash rate can increase fairly significantly over the next year or two. And if price stays, let's just say it stays flat where it is, the margins are very wide, so they'll compress, but most miners will still be in a decent spot. So we can sort of withstand a period where hash rate grows faster than price, certainly. Where miners are going to start getting in trouble, right, is if hash rate increases significantly combined with Bitcoin's price falling. And I think in that situation, we will see, what miners sort of took on, smart structures, smart debt deals, because I think very frequently we talk about sort of marginal cost of production for a Bitcoin, right? And frequently what we use in that calculation is an all-in hosting cost or an all-in electricity cost. And we therefore get to a break-even price where we say, okay, this miner is still going to be profitable as long as they're mining under a certain unit that a lot of miners use. Is, let's say, $1 per terahash per second per day, right? But I think what's actually missed there a little bit is that a lot of miners also need to make, have interest payments that they're making on top of that. And so it's not just, okay, the marginal cost of production, but really almost marginal cost of production plus the interest from these other deals. And there actually might be a wider spread there between a lot of miners. So when you ask sort of what will happen, and particularly in the context of like, is it going to stop traditional institutions like from coming in? I don't actually necessarily think it will prevent traditional institutions from evaluating the space, considering how to get in. But increasingly, they'll probably feel that there are fewer and fewer creditworthy miners out there in sort of a bear market condition. And so we might just see fewer and fewer deals actually being struck in that type of market.
But even that is probably just going to be another cycle,
Yeah.
like the many that we've had before, and we have to try and think past that. If we want to make long-term predictions, we could, people talk about this like super cycle, and I don't know how convinced I am. Everybody should walk into this knowing full well that if history is a teacher, we can have quite brutal price cycles, which again could turn into extra brutal conditions for miners because of the lag in the upwards direction of hash rate and price. It can take 6 months to deploy hash rate once price has gone up, but the price can fall very, very quickly to the point where you're going to struggle. And particularly if you've taken on a lot of debt and you have to service that as compared to your competitors.
So one of the things that I think going forward is going to be really important for miners is treasury management strategies, right? Which we've touched on a little bit here. A lot of miners are holding, there's one of them being derivatives, right? Or hedging solutions. So traditionally we've seen miners not be super bullish on hedging solutions because they think the Bitcoin price is going to continue to increase. So why, cap your upside? Why, do you think that still exists? Do you think that that's still a miner's thought process, or has that shifted? We're seeing more swings in hash rate, and how could miners actually use derivatives to their advantage to get access to more capital?
Yeah, I think there's multiple reasons why I think we haven't seen sort of the takeoff of derivatives necessarily in the mining space. There's certainly miners using them, but a couple of reasons. One, I think in a bull market, it just becomes a little bit less appealing, and a lot of miners become very confident that the price is just going to continue to go up. So why attempt to cap their upside through sort of various hedging solutions? So I think that's one reason. I think a second reason is that a lot of miners still just haven't educated themselves, and it certainly isn't the case across the board, but actually on how to use various types of products that in the traditional financial world are sort of very, very well known. And so there's still actually sort of this learning curve there of just understanding, what's a call, what's a put. Certainly not across the board. There's sophisticated miners that know that like the back of their hand, but others where they're still learning. And then I think the last reason as well is that a lot of miners sort of feel that they are almost sufficiently hedged just because of the way that mining economics work and the relationship between Bitcoin price and hash rate. So for example, if you're a miner and you know that you have a very low cost of production relative to other miners because you have very cheap electricity, you feel that there's almost a natural hedge in the market where if Bitcoin's price were to decrease, you know that other miners mining at more expensive levels due to higher electricity prices will turn off their machines before you. Therefore, hash rate in that situation decreases and you remain profitable. And so this period where we haven't been mining sort of at the margins, I think has just given confidence to a lot of miners in this feeling that they don't need to hedge. That being said, I absolutely believe that the use of derivatives will increase in the future. One, as miners do begin mining closer to their margins and closer to their sort of break-even levels, and start worrying more about price falls or unexpected increases in hash rate, and then as well just as miners learn more about how to use these products effectively.
Yeah. Go ahead.
Yeah, I mean, if you take the view that Bitcoin's digital gold and this is a commodity, you look at other commodity producers, and these are some of the biggest users of derivatives. Commodity derivatives are some of the most traded and liquid markets in the world because commodity producers that have capex and opex costs that are relatively fixed or which they can plan for, but are exposed to price or other factors that they can't. use those instruments in order to protect their businesses and to reduce the volatility of their cash flows. And again, in our thesis that the miners that will succeed in this next cycle are those that not only obviously have access to cheap costs of power, but have access to cheap costs of capital. We'll find that capital is cheaper for those that are able to generate stable cash flows. Which again, yes, historically volatility has been biased to the upside. Playing to the advantage of miners that avoided hedging. Again, I really feel that that the institutionalization of the space will drive it towards what are sound practices for every commodity producer for every other commodity, which is to utilize derivatives, to sell forward your production, and to at least cover your expected capex and opex, so that you're not finding yourself in a tricky position, because otherwise, again, you're going to end up having to sell your actual production at the wrong time. It obviously creates just significant threats to the business in terms of its volatility, cash flows, and potential viability of a business in a winter and a potentially sustained drawdown. So I certainly expect that this is going to increase and will be part of the trend of institutionalization of the industry.
Yeah, I agree with that, but we are missing a key critical component here, right? Because unlike a traditional commodities business, Bitcoin miner fundamentally doesn't know how many coins they're gonna get over any unit time, and so we need some way to hedge out difficulty as well. And we've been like cheering that on for years now, and it's just being very slow to materialize. And I think part of that is what Brian said, we're in a bull market. Like, why would you do that right now? And because nobody's doing it, we're not seeing any like liquidity developing in those markets, even though the products themselves arguably exist, and there are a bunch of them that could be used. But it won't be until a miner can sell forward their Bitcoin and hedge against difficulty that you'll be able to do the sort of traditional commodities financing models where you're effectively offering almost like a fixed income product. So we need that to develop first, but I think that's going to be the case too. We just need time, because the Bitcoin price should probably stabilize a little bit too before this is hugely necessary and required by the then arrived larger institutions, but also before a bunch of the miners, quite a few of which like the roller coaster a bit as well, I get the impression, are going to want to do this. But I also agree that huge future for derivatives in mining, and a little more complicated than normal as well.
I think, going back to what we're talking about here, I think that there may become a point where investors kind of demand it, right? Like if I'm going to invest in you, I need to understand that your production is going to continue to stay steady. And that might be really the way that this trends. There's almost like two different things that we're talking about here. There's Bitcoin derivatives and then hash rate derivatives, which, Chris, is kind of what you're bringing up. We've seen Bitcoin derivatives be a thing, right? Like we've seen people buy them, but hash rate derivative marketplaces are just a little bit still stale, right? We haven't seen a lot of people using those or even developing those. And I do think that there will be a really big market for that going forward, but looking forward to like seeing who's going to be like the winner in that space, because there really isn't one right now.
Yeah, so I think hash rate derivatives are also a critical component. I think from what we've seen from our clients on the mining side is that they perceive those instruments to be very inefficiently priced, which I don't think there's any reason that they actually should be inefficiently priced, because if the manufacturers of equipment were actually paying attention to that market and providing liquidity to that market, they should be arbing away any price inefficiency, because it would be very profitable for them. They have a very good insight into what difficulty is going to look like in the future, and should be arbing away any mispricing of difficulty. So either, so I think that the illiquidity of that market is, probably, an issue related to perceived inefficiency of pricing. And, I don't know for those who are active in that market or creating those markets, how much they're engaging with the manufacturers and kind of educating them on how they might be able to, generate an alternative source of income by bidding away or arbing away any price inefficiency in that market, so that miners actually want to utilize it.
Yeah, I mean, if we had insight into exactly how much hash rate was being sold at like the foundry level, right? Like I feel like all else would not be equal anymore, because it's like the holy grail, right, of an answer to the mining space.
And these markets could kind of provide that information through the pricing, which is pretty interesting. And if this happened, I mean, I think you make such a great point there. If this happens there, and the manufacturing space is sufficiently competitive, this could even drive down the price of ASICs during certain times. I mean, we talk about this a lot in our groups and stuff, but the inefficiencies are still substantial in this market. Not only pricing of various items, but information as well. Information efficiencies are huge. Talking about the need for research earlier, there still seems to be quite a big hype factor, even among public miners, and some of the more perceived boring providers who are more experienced and have done things for years and don't make such a big hullabaloo of things, seem to be inefficiently priced there as well. So huge opportunities, huge future potential for information to flow much better through more products that have prices that can tell us things such as this.
Yeah, it should be really interesting to see where financing and mining intersect over the next year. Do we think that there will continue to be a lot of public mining companies listing, or have we gone, is that like a bubble at this point? Like, what do we think the trends are going into next year for mining and financing?
I mean, we're certainly seeing a lot of intention and interest to list from miners that have that are increasingly viable to list. Again, I think personally, my concern on when that dries up is related to my previous comment, when I am concerned that a publicly listed miner that's overpromised potentially casts a cloud on the industry, or there's a correction in price that dries up the funding to the market. But I'm more worried about the former than the latter, personally.
Yeah, I think there's going to continue to be a lot of activity next year. I think it's proven to so far be a really effective tool for miners. I think it can be lucrative. It helps really scale the business. I think what I'll definitely be looking to is if the increase in just number of public miners out there leads to any sort of compression of valuations, compression of those multiples that they're trading at right now. I'm not sure I have an opinion on it, but it's probably going to be at least somewhat correlated, frankly, just the Bitcoin market. There's also investors out there that are just kind of using these companies as a proxy for Bitcoin exposure, and obviously they sort of trade at least somewhat in line with the rest of the market. But there's definitely still going to be a lot of activity next year, which I'm excited for, honestly.
Yeah, I feel like the party goes on for at least as long as the price continues to rise. And, if history is any teacher here, a little bit longer than that as well. Mining can, like Brian said, mining will probably remain profitable even way into either a flat or a downward price environment. So probably for a while longer.
Interested to see how that plays out. Well, guys, thank you for making financing, which can usually be a pretty boring topic, pretty fascinating here for mining. Appreciate your time and thanks for coming on the pod.